Okay, أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. So we continue where we left off. You see here the equity account of a proprietorship compared to a corporation. We have two different equity accounts here. One is the common stock, which is from the investment of the shareholders, and then you have the retained earnings. So both of them have a normal balance of credit. And in the proprietorship, you have owner's capital. Proprietorship is a sole owner. So everything is owned by the individual who owns the company, sole proprietorship. And all the money that he put in and all the money that the business made, they all go into the owner's capital account. So there is no separate account that accounts for the stock investment and the retained earnings, because this is all belonging to the same individual. Okay. All right. Now we are going to focus on the accounting of the common stock. The accounting of the common stock, the primary purpose here is to identify the specific sources of the paid-in capital and maintain the distinction between paid-in capital and retained earnings. So you have two major components in the equity section. One is the retained earnings, which is coming from the earnings that the business makes and keeps from the operations. Obviously, dividends reduce retained earnings, if you remember, right? Dividends reduce retained earnings, and net income increases it, right? So that's fairly simple. The accounting is a little bit more involved for the common stock. So what happens? I mentioned to you par value. So let's say this company issues 1,000 shares of $1 par value common stock. If the company issues it for $1, if the company sells the stock for $1 each, then the entry would be cash 1,000 shares for $1 each is 1,000 debit to cash, and then common stock 1,000 credit, right? If the company sells for an amount greater than the par value, then the entry is as follows. This is 5,000. So you have common stock 1,000, and the extra 5,000 is recorded in an account that is called paid-in capital in excess of par value. Right? Paid-in capital in excess of par value. You can imagine almost all the time the stocks are sold for more than the par value. Okay? Par value is a decided number at the beginning. You give the stock a small value before it goes and starts trading in the market. As soon as the company enters the market, the stock price now goes up and down based on a million factors. It's out of your hands. But when you're getting in, when you're authorized to issue, let's say 1 million stocks, each stock is assigned a par value, a small amount. Right? Sometimes it is not assigned. Okay? In that case, the board of directors can decide on an amount that is called stated value. Okay? So when the company is formed, the company is authorized X number of stocks at par value of $1, 50 cents, whatever it is, a small amount. If the par value is not decided at that time, then the board of directors can decide on something called a stated value, which is also similar to par value. Follow. So if you go to the balance sheet, the stockholders' equity would look like this. Common stock 2,000, the first 1,000 from the $1,001 par value, second 1,000 from the 5,000, and then you have paid in of 4,000, total paid in capital 6,000. Right? This is how it's reported on the balance sheet. You follow? Common stock 2,000, right? Where does the 2,000 come from? We have 1,000 here and 1,000 here. So there was two issues. The first time it was issued for $1, 4,000 in common stock. Second time it was issued for $5, and still the common stock. The common stock is always reported at the par value. Anything extra is paid in capital in excess of par value, right? Par value. Are you following?
If they were issued at $10 per share, the par value here would be
9,000. Yes. Yes.
But are these like two options, or we always have to like because there is an initial part?
No. These are two examples. You may never sell it for par value, which is usually the case. You may never set par value. Okay? Right. No. What happens when the company goes public? You already have shareholders before the company goes public, because the company does not go public when it is formed. Follow. The company grows and then it goes public. So you have a lot of inner works going on. The stock price. So for example, I remember when Krispy Kreme, you know Krispy Kreme donuts, I remember 1999, I think it was 99 or 2000, when Krispy Kreme went public, right? And I don't remember the number exactly, but it was something crazy. Like when they went public, the stocks were offered for $4, and like the next day it was $32. So if you had $4 million, the next day it could be $32 million if you could manage to buy $4 million of stock. You follow what I'm saying, right? So it is something, this happens like rapidly. These two numbers are just, I'm just giving you an example. I don't remember the number, but it was like that big of a jump. Follow? I will tell you a story about another corporation at the end. Remind me if I forget. It's a very interesting story that one accountant told us during a continuing professional education tax seminar. Okay, so there's no issue here. You understand what's going on here, okay? Same thing if you have no par value and you have stated value. So this company issues $5 of no par value stock, but it has the stated capital, stated value of 1. Same thing, instead of par value, you say stated value, right? If there is no par value and there is stated value, then the common stock is recorded as stated value and the extra capital is recorded as paid in capital in excess of stated value. Adil. The par value is decided at the inception when the corporation is formed. When you do the charter with the state and so forth. If the par value is not assigned, the legal team, they cannot do the par value, then the board of directors can do a stated value. They can decide on stated value. You can have stocks that don't have par value, that don't have stated value. It is possible. Okay? You might not have par value, you might not have stated value. If that's the case, this is what happens. Right? No par value, no stated value. So if the stocks are sold for $8, cash 5,000 times 8, 40,000, common stock 40,000. No par value, no stated value. So all of it is recorded in the common stock. But there is par value, only the par value amount is recorded in the common stock. The stated value, only the stated value is recorded in the common stock account. You follow? The rest is recorded in the paid in capital common stock. Why is this? Because you have to make things complicated, otherwise accountants will not have a job. Okay? So you have to make a little bit Very good. Now we have the preferred stock. What is a preferred stock? Preferred stocks are usually issued in cases where the company needs funds, right? And the preferred stocks have some, how should I say this? They have certain benefits or advantages above the common stockholders, right? You can own both, by the way. If you have, you can buy preferred stocks when it's offered, while you already also own common stocks. The preferred stocks would have some priorities above the common stockholder. That is the distribution of earnings. So the preferred stockholders are paid the dividends. It is possible that only the preferred stockholders are paid the dividend sometimes, and the common stockholders are not paid anything. It is possible, right? They would get the priority. If the company is liquidated, if the company goes out and the assets are sold, the preferred stockholders would have priority in the funds before the common stockholders. However, there is one restriction that is applicable in most cases. Preferred stockholders do not have voting rights, right? So this, you want to raise some funds and you're selling preferred stocks, but you don't want those preferred stockholders to gain control of the company. So somebody comes and buys a lot of preferred stocks, now they can their board of directors, and the board of directors then can select the CEO and run the company the way they like, right? So the preferred stockholders are approached for the money to run the business, and they're given money in exchange. So they will get dividends before the common stockholders, they will get the funds if the company is liquidated, but they will not have any say in the running of the company, even voting for the board of directors. You follow? Generally, that is the case. And accounting for preferred stock at issuance is similar to the accounting of common stock. So here, if you have $10 par value common stock, let's say, that is sold at $12, you can see already that the preferred stock have a higher par value. They're sold with the purpose of raising the funds. So same, if it's got $10 par value, then the preferred stock would be 100,000, and the extra, which is $2 per share, 20,000, would be in capital in excess of par value preferred stock, right? Par value preferred stock. Same accounting as the common stock. A couple of more examples here. The company begins operations March 1, issuing 100,000 shares at $1 common par value common stock, $12 per share. So here again, 100,000 times $1 is common stock, and then the rest is paid in capital in excess of par value common stock. Another example. This is the same concept. One more example of the preferred stock. 1,500 shares of $10 par value preferred stock sold at $30. So the par value is reported as preferred stock, and the excess is reported as paid in capital. Just a couple of more examples of the same that we have done. There is no difference in accounting. The only difference is the name of the account, preferred stock, and paid in capital in excess of par value preferred stock, and they are reported separately on the balance sheet. So far, so good? Okay. Then we have something called the treasury stock. What is the treasury stock? Treasury stock is the stock that the company buys back from the shareholders who have purchased the stock. So the company has certain rights to buy back the stock, buy back own stock. It can recall the stock, and when the stocks are purchased back from the owners, they're called treasury stock. They're shown separately on the balance sheet as treasury stock. Are you following? So it reduces the equity. You pay cash to the shareholders. You credit cash to the shareholders and they give you back the stocks. Those stocks are added to the balance sheet as treasury stocks. Okay, so let's take a look. Treasury stock is a corporation's own stock that it reacquires from the shareholders but does not retire. So they are still there on the balance sheet as treasury stock. The treasury stocks, a few reasons given here for getting the treasury stock, that is to reissue the shares to officers and employees under bonus and stock compensation plans. So remember, the authorized number of shares is limited. So the stocks are sold and the company wants to give some of those stocks to its employees and officers of the company, the CEO, CFO. It can buy back from the general common stock owners and give them the market value and give those stocks back to its own officers and employees to enhance stocks market value. So remember, the equity has a certain value in the market. So if you have 100,000 shares out in the market, it may be $10 per share. But if you recall 20,000, the 80,000 in the market each will increase in price, right? So the number, the value of the stock will increase. So the company could do it to enhance the stock price, to have additional shares available for use in the acquisition of other companies. So you can get stocks for stocks. You can exchange stocks for stocks. So instead of getting cash, you can have ownership in other companies by giving them ownership in your company. So if you need stocks for that, you can buy it back from your common stockholders, right? And to increase earnings per share. So earnings per share is the total earnings divided by the number of stocks. If the number of stocks are less, earnings for each share will go up. So if they have purchased back some stocks, then the earning for each stock will increase because the number of stocks go down. You follow? How do you account for this? It's at cost, right? So the cost, whatever you have to pay for the treasury stock, you debit the treasury stock for that amount and then credit the consideration, which is usually cash. The number of stock issued does not change, but the number of stock outstanding changes. What does that mean? Let's say you were authorized to sell 100,000 stocks. So your balance sheet will say authorized 100,000. Let's say you sold 50,000. So it will say issued 50,000, right? If you purchased 10,000 back from that 50,000 you sold, your issued will still say 50,000, right? But you will show 10,000 stocks in treasury stock. So the authorized is the same, the issued remains the same. You will say 100,000 authorized, 50,000 issued, 40,000 outstanding, meaning the other 10,000 you bought back, right? So 100,000 issued, 100,000 authorized, 50,000 issued, 40,000 outstanding. So if you have a difference between issued and outstanding, that means you purchased the difference as treasury stock. All right, let's take a look at an example. We have here 4,000 shares were purchased for $8 each. So now you see here, this is the balance sheet before the treasury stock. It says common stock, $5 par value, 400,000 shares authorized, 100,000 shares issued and outstanding. So as you see, $5 each times 100,000 is 500,000, yes? So 500,000 issued, $500,000, 100,000 shares issued and outstanding. So they issued 100,000 and it's still with the shareholders. Then the company goes and buys back 4,000 shares for $8. So there is no par value business when you buy the treasury stock. It's at cost. $8 times 4,000, you will get back 32,000 in your treasury stock. You're paying $32,000 cash to the shareholders. How is it reported on the balance sheet? Here is how. You will say common stock $5 par value, 400,000 shares authorized, 100,000 issued, 96,000 outstanding. Okay, and you will report the 500,000 like you did before. Nothing changes. What you will do is you come back at the end and you will subtract the 32,000 treasury stock that you paid for, the 32,000. You will deduct it from the paid in capital and retained earnings, and your total stockholders equity will be 32,000 less than what it was before. Right? So both numbers are disclosed, the authorized, the issued, and the outstanding, and then here the number of treasury stocks that you purchased. So this is all reported on the face of the balance sheet so that it is clear to the reader that what happened to the stocks, how many was sold, how many was purchased back, etc. 96,000 is 100,000 shares minus the 4,000. Right? So they issued 100,000, they purchased back 4,000. That means 96,000 is still with the stockholders. Okay.
So this 500,000 is the paid capital, right?
The 500,000 is the par value. There is, in this example, there is no excess paid in capital shown. The stock was sold at par value, so it will all go to common stock. If there is paid in capital in excess of par value, there is a separate line, which is if the stock is sold in excess of par value, which is almost the case, always the case. Okay. Which one? Previous one. So what happens? Okay. So what happens? You understand 400,000 shares are authorized, meaning the company can issue 400,000 shares maximum. This is authorized when the company is formed at the beginning. Okay. What happened? The company sold 100,000 shares for $5 each. So now the common stock is showing 500,000. Here, this part. Okay. Now the company purchased from the shareholders 4,000 shares from this 100,000. So the stockholders have 100,000. They recalled, purchased 4,000. They said we are going to buy 4,000 shares for $8. Who wants to sell? Right? So you have some shareholders coming and they're selling the stocks. So the company pays them $8 for each share. That's 32,000 paid to the shareholders who have the stocks, and they hand over the stock certificate. Each stock has a certificate. There's a certificate, stock certificate that you have, right? It proves your ownership. You have to give it back, right? Take the money and you give the stock certificate back. So the company records treasury stock on the balance sheet for that amount. Okay, this 32,000 is going to reduce the stockholders' equity by 32,000. The stockholders' equity and what? Company? No. The company is fully owned by individual. So you see, it is reducing the value. It does not increase the stockholders' equity. It reduces those stockholders 32,000. It is not a positive number. This is debit. This is debit to the stockholders' equity. Stockholders' equity, the owners had 500,000 equity before. Now they have 500,000 minus 32,000. The company does not own any stock. The stock is owned by the individuals. 4,000 shares the company called back. So you see here, you have 400,000 shares, 100,000 issued. Where is the other 300,000? It does not exist. The stock only exists if it is sold. The company does not have ownership without individuals owning the corporation. You follow? The company owns assets. The 4,000 is no longer there. It's no longer there. It's back with the other 400,000, other 300,000. So now there are 304,000 stocks that can be issued. Follow? That is right. It can be given to somebody else. If it is given to somebody else, they will then become deducted from? No, the 100,000, yes, it is deducted. It's shown 96,000 outstanding. That means right now the company is owned by stockholders who own 96,000. Okay? Does that make sense? So if we come here, this 32,000 is subtracted from the total equity, making it 668,000. Still not clear? Huh? Clear? How about you? What happened to the 4,000? Look, yeah, they don't have any value until they are issued. So what happens, what I was saying before, the stockholders have, the existing stockholders have preemptive right if the other stocks are issued. So what happens, let's say the stock price is $8 per share in the market, right? It's $8. I own a stock, and it's $8. It's $8 because only 100,000 stocks are in the market. If the company circulates another $100,000 in stocks in the market, my stock is no longer going to be $8. Follow? You follow? It's like currency. So let's say you have in the market 1 million riyals and you have a set of goods. This 1 million riyals can buy this set of goods. That's the price. If I print another 100 million riyals and I circulate in the market, and the price of these items will go up because the money now is more. Follow? Right? So that's why printing the money, if money is printed, extra money is printed and circulated, your 100 riyals in your pocket does not buy 100 riyal worth of goods when the money was not circulating. Right? In the case of the currency, you don't have the option to get the extra money. In the case of the stock you already own, you have the choice to keep your ownership percentage the same by buying that stock. Follow? Now, if you're a sound individual with sound thought process and so forth, this stuff is crazy. Follow? It's crazy stuff. Because there is some voodoo magic in there that is not explainable 100%. For example, when Steve Jobs falls sick, immediately your stock loses value. The company doesn't buy or sell anything in that one day. The stock price goes up and down based on
Market price.
projected based on future income. Okay? Based on future income. Why does it go up and down based on future income? The stock price goes up and down. It goes up when you have more people who want to buy the stock than the number of people who want to sell the stock. That's where the stock price goes up. So why do more people want to buy and fewer people want to sell? It is based on future earnings. Okay? The stock price will go down when you have many people who want to sell, and only few people who are willing to buy. Follow. Why does this happen? Because these people, large number of people that want to sell, see darkness into the future, see that the company is going down, I need to get out, right? These people, few people that want to buy, they have the money to buy and hold, right? Buy and hold. So they buy and they wait out the storm. Eventually, 10 years later, hopefully everything will settle and they will make out. You follow, right? Has nothing to do with the actual buying and selling of the business. This is a separate commodity. You follow what I'm saying? This is a separate commodity. This has its own life. Follow. All right.
It makes more sense next quarter when we have discussions with the economy.
Huh?
It will make more sense when we take the production fund.
We are all, accounting and finance are all, offshoots of another subject, economics, right? Okay, so we'll end here, inshallah. I will stop recording.